Okay, welcome back to our lecture on the principles and basics of banking. We are now at chapter 5, in which we talk about financial accounting for banks. As I mentioned last time, I have to give you a full disclaimer. This section is obviously about accounting and accounting rules for banks in Germany. So these might differ in other countries, but you still get the main ideas, which you will also find in different legal systems and different accounting regimes. We'll first talk about the purpose and functions of financial statements. I hope that every one of you has taken a class on financial statements, on annual reports, balance sheet and income statements, and we'll then talk about the financial statements under German commercial law, HGB, and under the International Financial Reporting Standards, IFRS. Now it should be clear to you that financial statements should provide accurate and truthful information to stakeholders, most notably to investors, who then base their decisions whether they should invest in such a company, whether they should invest in the bank, on that data, on these financial statements, to assess the default probability of that company. So it allows creditors insight into the bank's management. There is a fundamental difference, I think, between HGB, German commercial law, and the International Financial Reporting Standards. Now, accounting under German law is meant to protect creditors. Therefore, the annual statement provides the basis for determining a carefully measured distributable profit that is available to, say, shareholders in the form of dividends, but also to debt holders in the form of interest payment. Now, the objective of IFRS financial statements is rather to provide market-based information on the company's asset, financial and earnings situation, as well as their changes over time. These are not mutually exclusive, but IFRS has a different focus. It focuses more on market valuation of the company rather than a conservative look at what the default probability of this company could be, of the bank could be. And this is one difference between German commercial law and IFRS. Now we have special reporting and disclosure requirements for financial institutions. Obviously, just like we have also special accounting rules for insurance companies. And these can be justified by the particular business activities by financial institutions and banks. What is most important is customer and creditor protection. And this is the reason why the German Commercial Code, the HGB, has particular and specific regulations that only apply to banks and financial institutions. That's the main reason, because we want to make sure that the creditors, most notably the depositors of banks, are safe. Now, the purpose and functions of financial statements in general are basically the same for banks as for other companies. You should, as an investor, as a stakeholder, you should get a truthful and accurate picture of what is going on in the company. So they are used to provide information to stakeholders, most notably customers and depositors, suppliers, investors, usually institutional investors, but also employees or the general public. The general public takes a particular interest in the financial health of a bank because, as we've already discussed, banks might pose a systemic risk. So banks, especially if they are large banks, have an impact on financial stability and thus the financial sector as a whole. So the general public takes a special interest in the safety of deposits and the safety of a bank. And this is why the general public has an even larger interest and even higher interest in the accurate accounting of a bank. Now, in the case of banks, this focus is again on investors, most notably the depositors. So providing investors with information reduces existing uncertainties, and the uncertainty about future returns of an investment and the uncertainty about the conduct of the bank's management. In this respect, we often speak of the opacity of banks. What does it mean? It means a bank is opaque, and this simply says, and it simply means that as an outsider, as an outside external investor, there is actually no way you can really see what type of business the company is in. If you take Apple, if you take Tesla, you can observe what the company, what kind of business the company is in. They're producing iPhones, they're producing iMacs, they're producing Tesla cars. You can see the products and you see, and you can actually assess on your own whether this company has good products or bad products. But with loans, because these are confidential, it's very difficult for you as an outside, as an external investor, to see what the company, what the bank, the financial institution is actually doing in its lending business. So the opacity of banking makes it difficult for an external investor to actually accurately assess the risk you would be taking if you were to invest in these financial institutions. So shareholders depend on information about the future development of the company because they bear most of the entrepreneurial risk. You're a shareholder. Now, accounting should help them make better investment decisions, and therefore information must be available before the investment decision is done. Now, the expected return from an investment depends on how the management of the bank uses the funds deposited with it. And information on the bank's economic situation can provide information as to what extent the management has acted in the best interest of investors. This is, of course, true to most companies, or actually all companies. But again, because of the opacity of banking business, this is especially important for investors in a bank. So we need accountability. Investors in capital market-oriented companies, in contrast to shareholders of, say, a partnership, have to solely rely on annual reports to receive information on the financial well-being of the company. So extensive accounting, extensive disclosure requirements are needed and thus imposed on financial institutions. And in addition, all banks are required to publish their annual financial statements. So banks have to comply with accounting and valuation rules that are different from those for non-banks. Why? Because banking business is so different from, say, selling shoes, selling iPhones, selling Tesla cars. And the assets and liabilities side of the balance sheet consist almost exclusively of financial positions. This is also a difference to many industrial companies. With industrial companies, you usually have inventory, you have cars, you have real estate, you have some securities, and then you have your liabilities on the liability side of the balance sheet. With a financial institution, it's usually just cash flows and financial positions and financial securities on the left-hand asset side and on the right-hand liability side of the balance sheet. Similarly, income and expenses in the income statement result primarily from financial transactions like giving out loans, taking up loans, buying and selling securities, and therefore it is reasonable to impose on banks a more detailed breakdown of income, cash flows and expenses. So let's take a closer look at what is going on under German commercial law and German commercial code, the HGB. Let's start with the financial statement and with the balance sheet later on. The balance sheet contains information about the liquidity and risk situation. You have assets on the left-hand side, on the asset side, the Aktivseite in German. The assets are structured by decreasing liquidity and the liabilities by increasing maturity. This is the difference to the balance sheets of industrial companies. And we have a differentiation of debtors between public authorities, banks, and consumers. And thus we get some information on the default risk of certain positions on the asset side. On the asset side, there is a distinction between claims and securities. And on the liability side, we have liabilities and securitized liabilities. The securities, Wertpapiere, in German again, they must be internally assigned to one of the following three categories for valuation purposes. We have financial investments, trading portfolio or liquidity reserve. So depending on what you're intending to do with these investments, whether you want to keep it as a long-term investment, whether it's just on the balance sheet for trading purposes, so securities go in and go out all of the time, or if it's just a liquidity reserve, depending on these three bins you can put those securities into, you have to account for it in a different category on your asset side in the balance sheet. And for the latter, provision reserves may be created which allow for a deliberate undervaluation. So you might put in a lower price simply to be on the safe side. Net interest income and net commission income, they are shown separately in the income statement, and for some items, income and expenses can be shown after netting and offsetting. So let's dig a little bit deeper. Let's look at the legal basis, the statutes and laws from the German Commercial Code that are relevant for bank accounting in Germany. Banks must, of course, file annual financial statements. The annual financial statement or annual report consists of a balance sheet, the income statement, and the so-called notes, as well as a management report. In German, also Bilanz, G&V und Anhang und eben der Managementbericht, which must be checked, certified by a public auditor, by a public accountant. This is the German Wirtschaftsprüfer. Deutsch relativ klar. Jeder Jahresabschluss einer Bank muss entsprechend von einem Wirtschaftsprüfer testiert werden. Which special regulations apply and which statutes apply? We have paragraphs 340 through 340.0 in the German Commercial Code. These are the accounting provisions in the German Commercial Code. We also have the Verordnung über die Rechnungslegung der Kreditinstitute und Finanzdienstleistungsinstitute. In English, the translation could be the regulations on the structure and content of the balance sheet, income statement and notes of financial institutions and financial services institutions and credit institutions. And then we also have the German Banking Act, the KWG, which also includes some regulations regarding the reporting deadlines and auditing. So all these special statutes, they only include provisions that deviate from the general rules from the German Commercial Code. So HGB, the German Commercial Code, applies unless you have some rule that deviates from the general rule. For example, in the Rechnungslegungskreditverordnung, Kreditinstitutsverordnung. So these provisions applicable to all companies therefore also apply to banks unless you have some special regulations or laws that provide for different regulations. What is the structure of the bank balance sheet under German Commercial Code? Now, the formal structure isn't laid out in the German Banking Act or in the German Commercial Code, but it's actually in this executive order regarding the accounting of credit institutions. So a bank's balance sheet deviates from balance sheets of non-banks in the following ways. The order of the balance sheet items is reversed. So asset side begins with cash and cash equivalent. So the most liquid ones are at the very top, and then it goes down with decreasing liquidity, and the liability side with outside capital, external capital. Actually, that's a very weird translation. This is, of course, a debt. It's a very weird automated translation. So it starts with a debt. There is no division of assets into fixed and current assets. We have financial assets that are divided into numerous balance sheet items, because usually for industrial companies, they only hold a number of financial securities and they don't matter too much. With banks, the financial assets make up most of the asset side of the balance sheet. We also have tangible assets, which are combined into a single balance sheet position. And then information on the liquidity situation is provided by the static liquidity, that's the relation between assets and liabilities, and the dynamic liquidity, which is the degree of solvency guaranteed by future incoming and outgoing cash flows. So some balance sheet items are subdivided after term or maturity criteria, and in the notes for the financial statements, receivables and payables are broken down by time to maturity. Why? Well, because of the inherent and the frequent maturity mismatch you have on a bank's balance sheet, regulators and auditors are particularly interested in liquidity risk. So it makes sense to see those balance sheet items that are relevant for the financial situation of the company to be broken down into maturity and according to maturity criteria, to make sure that one can easily, when reading the financial statement, one can easily assess the liquidity of the bank. So this is what it looks like in Form 1 of this executive order. As you can see, it starts out with cash and cash equivalent, and then you have some payables and receivables. On the liability side, you have the liabilities to other credit institutions and debt. Actually, this is deposits, Spareinlagen, andere Verbindlichkeiten, securitized liabilities, and so on. And later on the next slide, you can see that at the very bottom, you see equity. And here you have different types of securities. So first of all, bonds, and then later on stocks and other things. And this is the rest. So this is the balance sheet, and it goes on. It's very detailed, obviously, and you don't need to know all the details. Now let's look at some of the more interesting positions on the bank's balance sheet. Financial assets, they generally define entitlements to future payments, for example, by granting loans, credit, purchasing shares, etc. The defining characteristics for the allocation to the individual balance sheet items are possibilities for refinancing with central banks, the marketability, and the legal status of the holder of the financial instrument. Now, because of their marketability and the ability to refinance, financing instruments possess a high degree of liquidity, so that the delimitation from non-tradable financial assets provides information about the bank's liquidity situation. And regarding the legal status, one has to distinguish between share certificates, which securitize ownership and membership rights, and debt instruments, which only represent creditor rights. So that's simple. You can see those are the different types of securities, more or less. Again, and actually these are no, not the securities, but claims, Forderungstitel in German. And here you can see where they have to be accounted for. So A2, A4, A3, and A5, they correspond, as you can see, to the numbers in Form 1. 2, 3, 4, and 5. Okay. Now, how can you account for debt securities? We have different types of debt securities, for example, shares, other instruments similar to shares, or shares of a limited liability company or a partnership. As you can see, they have to be inserted in A6, A7, or A8. So shares, for example, they go to A6 if they are neither A7 nor A8. If it's included in the consolidated financial statement of the conglomerate of the holding, then it enters A8. And if there is a permanent connection, a permanent link with this company of which you own the share, so for example, if you have holdings of more than 20%, and if it's not A8, so it's not included in the consolidated financial statement, and if you have a permanent link to that company, it goes into A7. If not A7 or A8, it goes into A6. Now, other instruments that are similar to shares always go to A6, and shares of a limited liability company or partnership, they are not allowed in A6, but they always go in A7 unless, as again, if it's included in the consolidated financial statement. Now, again, here under the balance sheet, item A6, all shares falling under the definition of securities are to be disclosed. So these are equity-like securities, investment shares, warrants, profit participation certificates, bearer or order papers, other non-fixed income securities, insofar they are listed on the stock exchange, for example, subscription rights. In case assets cannot clearly be assigned to items A6 to A8, you can resort to paragraph 271 in the German Commercial Code, in which the terms participations and shares in affiliated companies are defined for corporations. These are Beteiligung und Aktien an beteiligten Firmen. Now, under trust assets, A9, assets held by a bank in its own name but on behalf of third parties are disclosed. Then we have compensation claims against the public sector, including bonds from their exchange, A10. Let's go back. Ausgleichsforderungen gegen die öffentliche Hand, einschließlich Schuldverschreibung aus deren Umtausch. That's a very peculiar position. So it contains claims which arose in the course of the currency reform of 1948, as well as claims against the compensation fund currency conversion that arose in the context of the currency conversion during German reunification. You can leave that out. Term item intangible assets includes acquired concessions, industrial property rights, similar rights and assets, as well as licensees in these rights and assets if they are attributable to fixed assets. Now, A11 corresponds to the balance sheet item intangible assets in the accounting of non-banks, and not surprisingly, 11 is immaterielle Anlagewerte, immaterielle Vermögensgegenstände. So, for example, a patent is such an intangible asset. We also have property, plant and equipment, pending deposits on the subscribed capital, own shares or shares, other assets, accruals and deferrals. Most of them should be clear to you. Obviously, property, plant and equipment is a position, is an item on the bank's balance sheet, which will be rather insignificant. Usually banks don't have that much property, plant and equipment. They might even have none. So this is a very small item on the balance sheet. An amount indicated under deficit not covered by equity means basically you're insolvent, you're bankrupt. So if you have a deficit not covered by equity, A17, this is only relevant in case of bankruptcy. Okay, let's move to the liability side. So in contrast to A, Aktivseite, we now have P for Passivseite, in German for liability side. The liabilities are more important for banks than for non-banks, which is why they are more detailed listed in the balance sheet. The items are partially subdivided in the same way as the corresponding items on the asset side, and in line with the breakdown of receivables, we make a distinction between liabilities to customers and liabilities to banks with the same maturity structure. And the subdivision between receivables and securities corresponds to the differentiation between liabilities, P1 and 2, and securitized liabilities, verbriefte Verbindlichkeiten, P3. Let's go here. So we have verbriefte Verbindlichkeiten, securitized liabilities. This is a difference to P1 and 2. Now, securitized liabilities may not be registered securities or must be securitized in debt instruments, and they must be transferable. So this is obviously a requirement on securitized liabilities, because you want to make sure that these securitized liabilities they have these properties what you would expect of securities. Trustee liabilities are the counterpart to trust assets on the asset side. 4, P4, as you can see, these are trust assets, in German Treuhandverbindlichkeiten, die also treuhänderisch gehalten werden auf der Passivseite. We then also have other liabilities. These include all liabilities which cannot be assigned to P1 through P4. We also have accruals and deferrals. They arise from revenues which only represent income in future periods, in the same way as the accruals and deferrals on the left-hand asset sides. For example, a damnum or discount from lending is of significance here. So this is where something might enter position P6, accruals and deferrals. If we go back, it's pretty clear what is meant in German. das sind die sogenannten Rechnungsabgrenzungsposten. Is everyone clear what deferrals and accruals mean and how they are used? No one is asking a question, so I assume that everyone is aware of what accruals and deferrals or Rechnungsabgrenzungsposten, aktiv oder Passivseite, how they function on a bank's balance sheet. Okay. We also have provisions. They're used by both banks and non-banks to capture uncertain obligations. Provisions for anticipated losses from pending transactions, that is forward, option and swap transactions, are particularly important for banks. Provisions P7, that is the English equivalent of the German Rückstellungen. If you are expecting, if you expect that you might incur a financial loss, then you have to enter some cash into a provision. And this is in German Rückstellung. We then move on from the provisions to special reserves, P8. Banks are subject to the same regulations as for large corporations, and such special items may be formed either for tax-free reserves or for the difference arising from a special tax write-down and the depreciation required under the German commercial code. So this is actually, let me just see, this is actually gone. To check that. Now, in case of insolvency, we also have subordinated liabilities, P9. They may be fulfilled only after the requirements of other creditors and thus count as liable equity. Maybe only after the requirements of other have been met. This is a small typo here. What does it mean? Subordinated liabilities, these will only be paid back after other non-subordinated liabilities, more senior liabilities, have been paid back in case of bankruptcy. So this is closer to equity than to debt. We also have participation rights, capital, Genussrechtskapital, and the Fund for General Banking Risks. These are open reserves, but we don't need to move into more detail with these debt positions. Now, when it comes to equity, we have subscribed capital, capital reserves, different types of retained earnings, and the balance sheet profit or balance sheet loss. Now, as you can see, this is quite detailed. We have eingefordertes Kapital, gezeichnetes Kapital, Kapitalrücklage, Gewinnrücklage, gesetzliche Rücklage, satzungsmäßige Rücklagen, etc., etc., and balance sheet profit or loss that all make up the equity part of the liability side. A disclosure after partial use of profit is mandatory for banks, while non-banks have the option to set up the balance sheet before, after partial use of profit, or after complete use of the profit. However, equity items of a bank and a non-bank do not differ substantially. So we have it a little bit more detailed, but then again, we also have subscribed capital, capital reserves, etc., and retained earnings with non-banks as well. There are some items below the balance sheet line. These are transactions that may result in liability or credit risk for the bank. These are reported in the items below the balance sheet, so not in the balance sheet, but you can say as footnotes. And these incidents are to be reported if a claim is possible, and if a potential loss is expected, you need to form a provision for anticipated losses from pending transactions. Wir müssen eine Rückstellung bilden. The formation of provisions represents an expense, but the disclosure below the balance sheet line does not affect net income. Das ist der einfache Unterschied, wenn Sie es unter der Bilanz letztlich angeben, ist es genau das, letztlich eine Fußnote. Und dann weisen Sie darauf hin, dass es da möglicherweise eine finanzielle Verlustgefahr gibt. Wenn Sie natürlich sehen, dass es hinreichend wahrscheinlich ist, dass Sie da möglicherweise einen Verlust erleiden, dann müssen Sie eine Rückstellung bilden oder sonst natürlich auch einfach abschreiben. Das ist natürlich auch klar. Wenn Sie sicher sind, dass Sie Ihr Geld nicht mehr bekommen, dann müssen Sie sogar abschreiben. Contingent claims are Haftungsverbindlichkeiten, which may arise in the future. With non-banks, they are recorded below the bottom line as Haftungsverhältnisse. And we also have other obligations, and these include irrevocable loan commitments which justify credit risk. Now, most very important part of bank accounting is how to come up with values of assets and liabilities in the balance sheet under these accounting rules. So let's look at the different valuation rules for banks. The basic problem is that the valuation of an asset, if it's done under German commercial law, you have special valuation rules that apply to banks. Those are the paragraphs 340E through H of the German Commercial Code. And unless these special rules state otherwise, you have to stick to the general rules for corporations, for Kapitalgesellschaften, which are laid out in 279 to 2A3 of the German Commercial Code. And unless otherwise specified, the general valuation rules of 252 and through 256 of the German Commercial Code apply. First of all, we have the principle of prudence, which includes the realization principle and the imperative principle, Vorsichtsprinzip, Realisationsprinzip und Imparitätsprinzip. Gains may not be recognized in profit or loss until they have been realized, and potential losses must be taken account by setting up provisions or making extraordinary depreciations. And for assets, the lowest value principle applies, meaning that you have to take the lowest value you should anticipate for assets, and for liabilities you have to take the nominal value. Ja? Also im Grunde genommen bei Verbindlichkeiten den Nennwert, bei Vermögensgegenständen das Niedastwertprinzip anwenden. The distinction between a strict application and a moderate application of the lowest value principle, also strenges und gemäßigtes, meine ich, Niedastwertprinzip, depends on whether the asset belongs to fixed or current assets. And as the subdivision is missing from the bank balance sheet, a special provision is required. This is paragraph 340E, section 1. So assets are typically treated as follows. You have to apply the strict application for current assets. So this includes A2, 3, 4, 5, 6, and 15, and the moderate application for A7, 8, 11, and 12 for fixed and long-term assets. So how do you treat securities? You treat them like fixed assets, for example, financial assets. So you have to apply the moderate lowest value principle according to 253 section 2, meaning you only have to make a write-down, depreciation, in case of a permanent impairment, and write-down option in the event of temporary impairment. Was heißt das auf Deutsch? Sie müssen einen Finanzgegenstand, einen Finanzvermögenstand, also beispielsweise eine Aktie, die Sie halten, die müssen Sie, oder auch einen Kredit, den müssen Sie nach HGB nicht sofort abschreiben, wenn Sie davon ausgehen, dass es nur vorübergehend eine Wertminderung gibt. Vor allem dann, wenn Sie davon ausgehen, dass es ein langfristiger Vermögensgegenstand ist. Wenn Sie also langfristig investiert sind, dann haben Sie ein Abschreibungswahlrecht. Treat it like current assets, so if it's in the trading portfolio or if it's in the liquidity reserve, we have to apply the strict version of the lowest value principle. So write down obligation even in the event of temporary impairment. If the value goes down, you have to take the lowest value and you have to make a write down. And the write down option for expected fluctuations in value. So if these are expected, you again have a write down option. And for the liquidity reserve, the write down obligation even in the event of temporary impairment, write down option for expected fluctuations, and the provision reserves in accordance need to be made in accordance with 340F German Commercial Code. We then have three discretionary powers in the evaluation of securities. First level is we have a discretionary we have discretion in the allocation to the three categories. So if it's a financial asset, whether it's in the trading portfolio or in the liquidity reserve. Then we have a second level and discretion when it comes to the use of valuation options within each of these security categories. We have the write-down option in the event of temporary impairment. We have the write-down option for expected fluctuations and the write-down option for expected fluctuations and risk provisioning. And third, we have discretion when it comes to assessing the facts that are relevant to valuation. So is the reduction really temporary? Are there any future impairments to expect? And if yes, what size are they? And how much risk provisioning is necessary out of prudent commercial considerations. So you have three levels at which you have to decide how to deal with the true value of a security. What you need to do is first decide whether it's long-term, short-term, or liquidity investment. Second level is, should you use your write-down option in the case of a temporary impairment or expected fluctuations? And the third level is, how should you decide and what is a temporary impairment and what is a future impairment and future fluctuation, and what size will this future impairment be? How should we evaluate and value claims? Credits, loans. We have to delete those credits. That's a bad translation of loans. They are often granted or acquired with a disagio or agio, that is, the payout amount or purchase price does not correspond to the total nominal amount. In contrast to non-banks, banks can account for loans at nominal amount as long as the receivables are not included in the trading portfolio. So a disagio has to be included in the accruals and deferrals on the liability side, and it has to be amortized on a scheduled basis in the following years. For a premium, there is a choice between immediate offsetting as an expense and inclusion in the accruals and deferrals on the asset side with scheduled reversal. What does it mean? I'll say this in German. Wenn Sie Forderungen hier bewerten müssen, dann haben Sie ja bei Banken häufig den Fall, dass es da ein Disagio oder Agio gibt. Das heißt also letztlich einen Preisabschlag, dass Sie entweder ein Betrag nicht komplett ausgezahlt worden ist oder dass Sie was da drauflegen müssen. Und in diesem Fall Banken können diese Kredite, können ihre Kreditverbindlichkeiten oder auch Forderungen, können sie zum Nominal, zum Nennwert, können sie den bilanzieren, müssen dann aber natürlich das Disagio oder Agio dann über einen Rechnungsabgrenzungsposten dann berücksichtigen und das dann natürlich über die Zeit dann amortisiert dann entsprechend verbuchen. Now, when calculating the carrying amount, one has to determine whether the carrying amount of the previous period is appropriate, considering the current credit worthiness of the debtor. And in case of recognizable default risk or country risks, an individual value adjustment is made. And in case of latent risk, which are not yet obvious, a flat rate value adjustment is made. For risk prevention, risk reserves can be formed. Generally, this means that if you value claims, loans, in case the default probability of the debtor changes, you need to think about write-offs. And the question now is, do you do a single write-off for a single investment, for a single loan, or do you do a general adjustment in, say, a portfolio of loans, for example, due to country risks? Das ist also die Frage, ob Sie eine Einzelwertberichtigung oder eine Pauschalwertberichtigung vornehmen. What is done? You take the nominal residual receivable amount, the expected repayments by the borrower, the expected proceeds from using up the collateral that you have, and this is the amount of the individual value adjustment. Very simple. I'll say this in German. Wie berichtigen Sie denn dann den Wert? Sie nehmen den Restbetrag, der noch aussteht. Also sagen Sie mal, Sie haben ein, I can say this in English, this should be clear. Imagine you've given out a loan with 100,000 euros nominal value. 50,000 euros have already been paid back, so you are still expecting a residual of 50,000. You expect that you will get 20,000 back, then you can use 20,000 in collateral. So what you are left with is 10,000 euros that you will probably never see as the bank. And this is the amount of the individual value adjustment. So this is the write-off. German say this in German again, relativ einfach. Sie haben 100.000 Euro in Krediten vergeben. Sie haben 50.000 schon zurückbezahlt bekommen. Sie erwarten, dass Sie 20.000 noch zurückbekommen von dem Kreditnehmer. 20.000 Euro können Sie aus der Verwertung der Sicherheiten nutzen. Und dann sehen Sie, es bleibt 10.000 Euro bleiben über, die Sie nicht zu bekommen werden. Und dann müssen Sie natürlich eine Einzelwertberichtigung dieser Forderung in Höhe von 10.000 Euro nehmen. What can you do if you want to make not an individual value adjustment, but a generic write-off on, say, a portfolio? So the general provision for doubtful or risky debts, these are rather shady translations, I have to say. So the general provision is built by a default ratio times the risky credit exposure or credit volume. And the default ratio has to be calculated by the average bad loan loss minus the minimum of the individual or specific valuation allowance, die Einzelwertberichtigung, and 40% times the average bad loan loss divided by the average loan volume that is risky. Of course, you would only consider those that are risky and not those that are risk-free. Very interesting. Derivatives. There's a big typo here. This is derivatives. Now, for derivatives, we have many different rules on how to account for them and how to value derivatives. We have option rights, option issuer positions, and futures trading. And as you can see, we have 3 different points in time when we buy or sell the contract. The valuation on the balance sheet if the contract is still active, and the settlement or exercise date. What happens? With a call or put, it's accounted under other assets, A15, sonstige Vermögensgegenstände, with a possible write-down on the balance sheet date of the option premium to the lower stock market price, and at settlement or the exercise date with the purchase price, which is the option premium plus the exercise price, and for the put with the sales revenue, which is the exercise price minus the premiums. Might be positive or negative, but then it will be included in the income statement. For option issuer positions, accounting of the option premium under other liabilities. For a call, for a put, it's P5 or other provisions, P7C. Reporting the initial margin under advances to customers, A4. And it is possible to create a provision for impending losses, eine Rückstellung für mögliche Verbindlichkeiten from pending transactions. Calculation of the provision, it's the difference between the stock market price on the balance sheet date and passivierte option premiums. And here you can see it's the same as for option rights. With futures trading, it's reported the initial margin as advances to customers under A4, and you again can create a provision for impending losses, and the agreed forward rate is in both cases used at settlement or exercise date for valuing these forward or future contracts. Okay, now let's move to the income statement. Again, the structure and the layout of the income statement is regulated now in forms 2 and 3. Unlike non-banks, banks can choose between a single and a double column layout. We call this Staffel- oder Kontenform in German. And the classification is based on different possible criteria. Maybe we can separate income expenses from lending business, those from securities and services business. We can separate operating from value expenses, expenses and income into operational and non-operational components. That's all possible here. And let's take a look at the income statement. It starts with interest income, then, interest expenses. We have non-interest expenses. Then we have personnel, write-offs, as you can see here, with interest income, income from securities transactions and so on. This is non-interest income, Provisionserträge. This is the income from especially investment banking. non-interest income, and then we have the net income and net expenses, and in the end with some write-offs, etc. And we also have a net loss or a net profit. Now, net interest income, A1 interest expense on the left-hand side, and on the right-hand side with interest income from lending and money market transactions, fixed interest incomes, and current income from shares, investments, holdings, E1 and E2. The net trading income is built by looking at A3 and A5. We have those financial transactions, expense components, income components, securities held for trading, realized losses, realized gains, depreciations, appreciations, and so on. And these form the net expense and income from financial transactions. We also have the gains and losses from other securities and receivables. We also, for example, here for the earnings from liquidity reserve securities, we do have a netting option. I don't want to go into too much detail here. You can see that the gains and losses are basically taken from the lending business, interest income and interest expense, and all the different gains and losses from securities transactions and provisions. So we also have net income from investments, A7, A8 and E7. Again, you have to look at those realized losses and gains, and then you have the income statement. Now next, let's look at the notes in the management report. So this is the German Anhang. Which information has to be provided in the notes is stated in paragraph 34 through 36 of the regulation concerning the accounting of credit institutions. In addition, we also have the general rules of 284 through 287 of the German Commercial Code. So what needs to be included in the notes? Information on the applied accounting and valuation methods. So you need to report on how accounting is done. Further explanations of the balance sheet and income statement. And we also have disclosures on off-balance sheet transactions, for example, forward and option transactions, as well as swaps, so financial derivatives. With regard to the management report, there are no special regulations, but usually financial regulators will require some information that is also included in the management report. Okay, that's the notes. Not very fancy and I guess not too interesting. It's important to see, especially for the public auditors, to see which kinds of decisions were made during accounting and which accounting and valuation methods were used. So let's now turn to the International Financial Reporting Standards. Now, all banks are required to keep their accounts under HGB, German Commercial Code, but the large companies and international ones are required to file their reports under International Financial Reporting Standards. And the IFRS annual financial statements, they also include notes and a cash flow statement. And major difference is financial instruments are significant for accounting and valuation purposes, including financial assets, financial obligations, and also equity instruments. They are divided into those held for trading, those held to maturity, and those held for liquidity, similar to German Commercial Code. And the trading and liquidity portfolio is valued at fair value. This is one large difference. We've seen the valuation rules for securities and for securities held as fixed assets, feste Anlagen, feste Vermögensgegenstände, and trading portfolio and liquidity reserve. And under IFRS, you should remember this, it's always fair value accounting. So you're looking at the fair value, which in many cases is the market price. Some others are valued at amortized cost, but fair value accounting is probably the main takeaway from IFRS. So what is the legal foundation for IFRS bank accounting? We have a number of IAS standards, International Accounting Standards, that apply to the IFRS annual financial statements. These are the following ones: IAS 30, 32, 39, and 21. As you can see, these specify bank-specific standards for disclosure, reporting requirements, the disclosure and reporting obligations for financial instruments, and so on, and what is done under IFRS. First of all, there are no formal requirements for the IFRS balance sheet. There are only recommendations on minimum disclosures in the balance sheet, which is in IAS 30. The number of items in the IFRS balance sheet is significantly lower than in a German commercial code balance sheet because a lot of the information is relegated to the notes. This is what it looks like, again, unfortunately in German. As you can see, we have the long-term investments and current assets. We have equity at the very top of the liability side, long-term liabilities and short-term current liabilities. It looks pretty similar to a German commercial code balance sheet. A financial instrument now is, under IFRS, a contractual agreement which leads to a financial asset at one company and a financial obligation at another company. So we have financial assets, cash, receivables, option rights, equity instruments, financial liabilities, issued debt securities, loans, written options, and also equity instruments like shares, preference shares, or warrants. All these financial instruments are valued in these four different categories. We first have financial instruments at fair value through profit or loss. So these are the trading assets, receivables, shares, derivatives, foreign exchange products, trading liabilities, written options, short sales, and fair value options. So these need to be valued and accounted for under fair value. For those that are held to maturity, we have financial assets with specific or determinable cash flows or fixed maturity that are held to maturity. We have loans and receivables, own or bought non-derivative financial instruments with fixed maturity and no short-term intention to sell, so we don't want to trade with them. And they are not designated as financial assets at fair value or available for sale. And last but not least, we have available for sale financial instruments. These are not classified as one of the previous three, and all equity instruments that are not financial assets at fair value are also included in this fourth category. So how are they valued? Financial instruments are valued at the cost of acquisition, and subsequent valuation, sorry, there's again a typo, is at fair value or amortized cost depending on their category. In the case of amortized cost, we have changes in value that occur only if the asset is sold or if there are indications of impairment, so that an impairment loss has to be recognized. What are such indications of impairment? If we have an objective indication of a permanent impairment based on a past event after valuation, and if this event affects future cash flows, then we have a permanent impairment. I guess this table makes it more easy to understand. If we have assets on the asset side, if these are loans held to maturity, the valuation standard is at amortized cost. Do we have to do an impairment test? Yes, and it will affect net income. Is the impairment reversed? Yes, it will also impact net income. Those assets that are available for sale are valued at fair value. It's profit neutral if we have a fair value change. Yes, also impairment test, it's affecting net income. For a debt instrument, so Schuldtitel, it will affect net income. And for equity instruments, Eigenkapitaltitel, it's profit neutral. For those assets that are either an asset or liability, for those financial instruments at fair value, we have fair value accounting affecting net income, and this is implicitly done through the fair value approach. For other liabilities, they all have to be accounted and valued at amortized cost. We will not account and not treat any fair value changes, and the impairment test is not applicable. So as you can see, for large parts of a bank's financial instruments and for most of its assets, you will see fair value accounting under IFRS accounting. So this is a huge difference to the rules under the German Commercial Code. Let's now turn to the income statement. Very simple. As you can see, we start with interest income minus the interest expenses. We have the interest surplus minus the risk provisions for the lending business, yields the interest surplus after risk provisions. And then we have fee and commission expenses and income, and the trading income, the result from available for sale assets, result from financial instruments, and so on and so on and so on. And in the end, we get the annual net profit or annual net loss. What is important is what you will also find in some papers, and there's one by Brunnermeier Dong Palia in the Review of Corporate Financial Studies, which is an interesting paper. What they do is they argue that if you look at interest income or interest surplus, so the same, that this is commercial banking or just the lending business. In contrast, if you rather have a look at the fee and commission income, so fee income, aka non-interest income, this is indicative of investment banking. So das ist in German, ist ein schönes Paper eigentlich hier von Brunnermeier Dong Palia, ist auch schon 10 Jahre alt, er ist jetzt veröffentlicht worden. Das ist eigentlich ganz schön, Sie können an der G&V einer Bank eigentlich sehr schön erkennen, was die machen. Wenn die ein hohes Zinsergebnis haben, dann vergeben sie natürlich mehr Kredite und finanzieren sich über Depositen. Wenn sie dagegen aber ein höheres Provisionsgeschäft haben, also hier die Fees and Commissions oder zusammengefasst einfach als Non-Interest Income, nicht Zinsgeschäft, das deutet fast immer auf Investmentbanking hin, weil wo verdienen Sie schon Gebühren und Kommissionen und Provisionen? Natürlich im Investmentbanking. Also deswegen haben die 3 Autoren hier, Brunnermeier, Dong Palia, die haben diese Unterscheidung einfach getroffen, die haben sich Bankbilanzen und G&Vs angeschaut in den USA und sagen einfach, je mehr Non-Interest Income man findet, desto mehr Investmentbanking machen die Banken. Das ist ein ganz schönes Paper. Okay, let's turn now to the cash statement, the cash flow statement and cash flow calculation. Cash statement provides information on the events that caused the change in the cash reserve and provides an insight into the bank's liquidity situation. So you take the annual net profit, you add the non-cash effective expenses, you subtract the non-cash effective income, and you get the change in cash. Now, cash inflows and outflows, they can be further divided into 3 parts. Cash flows from operating activities, annual surplus adjusted by non-cash expenses, cash flow from investing activities, and last but not least, cash flow from financing activities. So, for example, payments that are related to self-financing. Then you get the cash statement. If you take any IFRS balance sheet or annual report rather from a large bank like Deutsche Bank or Bank of America, or not Bank of America, but take Deutsche Bank or Paribas Bank, BNP Paribas, you will see those 3 parts. Annual report consists of balance sheet, income statement, and the cash flow statement. This is then extended and extended by the notes in Anhang. Again, the notes correspond in most parts also to the notes for German Commercial Code financial statements, but the disclosures are much more detailed. Why? We have information about the group relationships, about the holdings. The notes to the balance sheet and income statement in particular include a representation of the accounting methods, a breakdown of remaining terms, of detailed information about the composition and valuations of the individual balance sheet items, related interest rate and default risks, detailed information about the individual expense or income items, and explanations of the objectives and strategies of risk management. So what we do find is a so-called risk report, also ein Risikobericht. A segment report, which breaks down the income, expenses, assets, and liabilities according to business departments, geographic segments. We have information about events after the balance sheet date, information about contingencies and other obligations. And all this is included in the notes, in addition to the notes you would find under German accounting laws. Okay. So this, in a nutshell, very quickly, is financial accounting for banks. As you can see, the most important differences when it comes to financial accounts of banks is due to the detailed valuation rules for financial instruments, financial claims, financial positions in general, and then they slightly differ under HGB, HGB, and IFRS accounting standards, but most of the time the difference will be in a more detailed and more, how should I put it, more detailed and more elaborate valuation of financial instruments, because for industrial companies, they are not trading in financial securities. This is not as important as for banks, but for banks which only have financial positions most of the time on their balance sheet and in their income statement, they need to abide by more specific rules when it comes to the valuation of financial instruments. Okay, now we've already arrived at section 6 here, which is on risk management in banks. And I would say, because it's again late in the evening, we can stop here because we're actually pretty good in time. Do you have any questions concerning the accounting rules for banks? Because if not, I would say we can stop here for today. And I hope you have a nice evening, and we can then continue next week. Thank you and have a nice week. Bye-bye.